Hello everyone, welcome to the first marathon class of our BRBL preparation series in English medium. So here in this series starting from today, we are starting the marathon classes in which we are going to discuss the MCQs in such a way that we will complete the syllabus revision in a manner that is going to help you achieve the success, achieve the qualifying marks so that you can qualify the examination. So your BRBL paper, which is on 14th of December, you have exactly this time starting from today in which we are going to have daily sessions till your examination day. In today's video, we are going to cover the module A in one video. We are going to discuss the MCQs, not just the question and answers, but also the complete topic so that you don't need to turn pages to revise these topics again. You can simply complete the revision here itself in this video. Tomorrow we will have the module B, then module C and module D. Then on 13th, that is before your examination, we will have a complete marathon starting from 6 p.m. so that we can have a complete revision, the final revision of our BRBL paper. So we are targeting the CAIIB BRBL for the December 2024 season. And seeing the trends in the previous examination, we are seeing that the questions are being asked, they are of a very high difficulty level. So we are going to try to solve these questions which are again of a high difficulty level. If you are able to solve these questions, you'll easily solve all the questions in your examination. The questions that I have prepared for today, these consist of the direct MCQs as well as the multiple selection type questions. So there are going to be some lengthy questions as well. We are going to complete the case studies in another session. In one complete session, we will discuss only the case studies of all the modules. So now let us start. If you haven't yet seen the strategy of how we are going to approach the 7 days for the BRBL exam, the video is already uploaded on the YouTube channel, this YouTube channel of English medium. This class is going to be completely in English medium, in English language. We are going to cater to the aspirants who are comfortable in this particular medium. So quickly join the session, share it with your other friends, share it with other aspirants, and try to be very active. Try to answer to the questions that we are going to discuss here. Alright, so now let us see what is the first question. We are going to move unit wise from all the modules. So the first question from module A is right here. According to Section 5B of the Banking Regulation Act 1949, which functions are essential for an institution to be defined as a bank? So Module A contains two acts that are of the most importance, the Banking Regulation Act and the RBI Act. This question is the most basic question that the institution can ask. What is the definition of a bank under the Banking Regulation Act of 1949? Option A says managing investment portfolios and providing financial advice. Option B, accepting deposits from the public and lending or investing those deposits. Option C, offering the insurance services and wealth management. Or option D, conducting the foreign exchange transactions and providing remittance services. So according to the definition given under the section 5B of the Banking Regulation Act of 1949, which functions are essential? The function that we are seeing here are the functions performed by a bank but essential to be defined as a bank. The correct answer is option B. So definition of banking as the activity of accepting deposits of money from the public for the purpose of lending or investing. So here we see certain components of the definition: accepting deposits but from the public, from the public. And the characteristic of this deposit should be that they are repayable on demand or otherwise, withdrawable by the check, draft, order or otherwise. So deposits from the public, and they're only accepting money deposit, not goods. Tangible are not accepted, but monetary deposits by the public, and they should be withdrawable, right? repayable on demand. So demand deposits. The key functions highlighted are accepted deposits, lending, investment, which are fundamental to the definition of banking under the Act. So the correct answer is option B. I think this question is of a very basic level, right? You can easily answer this question. But again, we need to revise the definition, so I have put it here. Let's move on. Next question, which entities are authorized to accept deposits withdrawable by the check as per section 49A of the Banking Regulation Act? In the previous session of the BRBL paper, a lot of questions were asked from the sections and the subsections of the acts. That is why I have mentioned in the questions and the statements the section. So section 49A, which entities are allowed, authorized to accept deposits? The non-banking financial companies regulated under the 1998 Reserve Bank directions, any individual or firm with a government permit, only banking companies, RBI, SBIs, and entities notified by the central government, all cooperative societies and associations of bank. So in the previous definition, we saw the previous question, we saw the definition of banks. So they can accept the deposits that are withdrawable, that are repayable on demand, right? So we did not mention the NBFCs because they are not allowed, the individual or firms, cooperative societies, but only the banking companies. The companies that can use the term bank in their name, RBI, SBI, and other entities that are notified by the central government. So only the regulated and the trusted institutions can manage such transactions, maintaining financial stability. The non-banking entities, they are not allowed or permitted to accept such deposits. All right, so only the banking companies are allowed. So we are still continuing with the definition of banking. Under section 5B, what is banking? Then under section 49A, which entities are allowed? Other sections, the 49A, apart from that, the acceptance of deposits by the non-banking entities, so the NBFCs, accepting of the NBFCs is by another directions that are given by RBI, like under the acceptance of public deposits of 1998 or the chapter 3B of the RBI Act. But under 49A, only the banking company, RBI, SBI, and other institutions are allowed to accept deposits. Also, they can use the term bank, which is given under a separate section, right? Next, so this section that states that only the banking companies or those that have a license from RBI, they can use the term bank in their name. That is under section 22. That is also we are going to write here. So section 22 says only they can use the term bank. Okay, very important question. Which activity is prohibited for banking companies under the section 8 of the Banking Regulation Act? So which section mentions the prohibited activities under the Banking Regulation Act? The section 8. So here we can see from a single question we can come up with very different concepts, right? So accepting deposits from the public, engaging in trading activities directly or indirectly, providing loans and advances, offering financial advisory services. Which of the following are prohibited? We have seen traditionally the main definition of banking, that accepting of deposits, lending, investing are the main activities. Other than that, activities that are permitted are included in the section 6.1. Under section 6.1 of the Act, the permitted activities like dealing in bills of exchange, drawing, accepting, buying, selling, with or without security, managing, selling, and realizing any property, these are allowed. But section 8 states that there are certain prohibited activities that are not permitted. The banks cannot undertake these activities. So under this section, one of the mentioned activity is engaging in trading activities directly or indirectly, right? Trading of trading activities. All right, so this is prohibited. Section 8 of the Banking Regulation Act prohibits banks from companies trading in the activities directly or indirectly. This includes buying, selling, bartering goods with certain exceptions. So they cannot involve in activities of selling and buying of goods, of tangible goods, right? This is to minimize the trading risk, focus on core banking activities. They are allowed to realize the securities. Let's say a security was given for a loan which becomes a non-performing asset. Now the securitization or realizing of the security is not prohibited, right? They can realize the securities that are held for loans, they can manage the estates, they can perform the portfolio management activities, but are restricted from holding immovable property for more than 7 years unless extended otherwise by RBI. Okay, so engaging in trading activities directly or indirectly is prohibited. It is not permitted under the section 8 of the Banking Regulation Act. Next, under which sections of the Companies Acts are the foreign banks transacting business in India treated and regulated? Now, although this question is very tricky, but it becomes important because in the previous session, like I just said, questions from the sections were asked. So, somewhere or the other in this attempt also, you will find questions from the subsections of the acts. So here it is asked, under which sections of the Companies Acts are the foreign banks transacting business in India treated and regulated? Option A says Section 3 and 591 of the Companies Act of 1956, the Section 242 and 379 of the Companies Act, Section 3 and 379 of the Companies Act 2013, Section 242 and 591 of the Companies Act 1956 and 2013. So, different banks they exist in India. The public banks, RRBs, private banks, and foreign banks. So here the question is asking, foreign banks, their treatment, their regulation comes under which sections of the Companies Act? So most of the private sector banks, which also includes the micro and the small finance banks, are constituted under Section 3 of the Companies Act, or under the Companies Act of 2013 or 1956. But when we are talking about the foreign banks, they are treated as under the Section 242, the Section 2, subsection 42 of the Companies Act 2013, and the regulation is done under the Companies Act under Section 591. So the correct answer is option B. Um, Right. So foreign banks operating in India are treated as the foreign companies under Section 2, subsection 42 of the Companies Act 2013. Additionally, certain provisions of the Companies Act of 1956 or 2013 are such as the Section 591 of the 1956 Act and Section 379 of the 2013 Act become applicable to these entities. All right. So this regulatory framework is going to ensure that the foreign banks they comply with the Indian laws and they're regulated while conducting the banking business in India. Okay, so you need to remember these sections and the subsections. Like the RRBs comes under the RRB Act of 1976. Then the cooperative banks are enacted with the Cooperative Societies Act of 1904. SBI under the SBI Act of 1955, right? So this is how the sections and subsections become important. Next question. What prompted the introduction of the Banking Regulation Act 2020? So the amendment in the Banking Regulation Act which was made in 2020. What was the reason for this amendment? The need for modernizing the financial technology in banks, the success of cooperative banks in the multiple states, the failure of the PMC Bank in Mumbai and issues in the cooperative banking sector, the expansion of foreign banks in India. So, which of the following four options are the reason for the amendment that was made in 2020 in the Banking Regulation Act? The correct answer here is option C, the failure of the PMC Bank. So there are a large number of problems that were seen in the cooperative sector and the cooperative banks, like the failure of the PMC Bank. So the government had to amend the Banking Regulation Act to increase the power, to give more powers to RBI so that they can regulate these entities. Thus, it was introduced. Okay. So the correct answer is option C, the failure of the PMC Bank in Mumbai. All right. Next question. Under which sections of the RBI Act does the Reserve Bank of India act as the lender of last resort? Again, a question that is asked from the sections. So RBI performs various functions. There are some quantitative functions and then we have the qualitative functions as well. RBI works as the stabilizer using its monetary policy. Then it acts as the banker to the government as well as the banker to the banks. It also provides advisory services. Then the manager of various records of the various deposits. The SLR, CRR is controlled by RBI. Under the monetary policy, it also uses a quantitative as well as qualitative measures like the moral suasion method. So, one of the many functions that is performed by RBI is lender of last resort. That is when the banks they are in the situation that they can go bankrupt. Then they can resort to RBI for availing loans. So this is the function of lender of last resort. So the question is asking us this function comes under which section? Option A says section 17 and 18, B says 7 and 8, C says 22 and 30, and option D says section 19 and 42. To under which of the following sections does RBI acts as the lender of last resort? So the RBI Act 1934 came into effect on 6th March to basically to give more powers to RBI, how they can regulate the issue of bank notes, keeping of reserves, securing the monetary policy, the monetary stability, how to operate the currency and credit system. Okay, so when there's a run on a bank or any other financial institution, the RBI may act as the lender of last resort under the section 17 and 18. This role involves providing funds to the banks or other financial institutions that are experiencing financial difficulties, especially during the liquidity crisis, so that any adverse effect on the economy or the banking system can be managed. All right. So the correct answer is 17 and 18. Other functions which the RBI performs, like the management, which comes under section 7, the establishment comes under section 3, the right to issue bank notes. It is the apex wholesale authority that can issue bank notes. It comes under the section 22, right? The cash reserves that are maintained by the scheduled banks come under the section 42 and so on. So there are various sections under the RBI Act. Alright, so the correct answer here is option A. Next, what was the original name of the Banking Regulation Act 1949 and when did it come into force? So this question has two parts. This can also be asked in a fill in the blank format. The original name of the Banking Regulation Act was dash and it came into force in dash, and you will be given options in brackets. All right, so here it is asking two things: what is the original name and when did it come into force? Option A says Banking Companies Act 1949 and came into force on 1st March 1966. B says Banking Regulation Act 1949 came into force on 16th March 1949. Banking Companies Act 1949 came into force on 16th March 1949. Or option D, the Banking Act 1949 that came into force on 1st March 1966. Which of the following options is correct? Try to answer this question. So, the Banking Regulation Act 1949, which regulates the banks in India, it was passed as the Banking Companies Act 1949 that came into force on 16th March 1949. The Banking Companies Act. The name of the statute was later on changed to the Banking Regulation Act, effective from 1st March 1966. And since then, it has undergone several amendments to include the cooperative banks, adapt to the changing regulatory needs. Various sections were added, various sections were removed, right? Also, the amendment that we saw, 2020 amendment, related to the primary agriculture credit society or the cooperative society, wherein these section 3 will not be applied. Okay, so the Banking Regulation Act, it came into force originally as the Banking Companies Act, right? Also, it became applicable to Jammu and Kashmir from when? Since 1956. Before that, it was not applicable to the state or now the Union Territory of Jammu and Kashmir. Okay, next question. Under which section of the RBI Act does the Government of India have the authority to give directions? Now, RBI regulates most of the functions of banking. It is the main wholesale authority of various things, but still the central government has certain powers over RBI. It can give directions to RBI in public interest. Let's say in the situation of a very high inflation, the government advises the RBI to bring down the, or in the case of inflation, bring up the interest rates. Interest rates. So if the interest rate will go up, it would become difficult or costly for the people to take or avail loans from the banks. All right. So the government, it uses its fiscal policy, and it asks RBI to accordingly manage its monetary policy. So that in situations like inflation or in war-like situation, maybe to control deficit financing, RBI can take according actions. So under which section does the Government of India have this authority? Section 4 and 53, Section 10B and 36AA, Section 22 and 14A, or Section 7 subsection 1. Under which section does government can act as a regulator of the bank, we might say that the government can act as regulator of the bank. So although RBI is the primary regulator of bank, but the central government has also been conferred extensive powers under RBI as well as the Banking Regulation Act, that they can either directly or indirectly regulate the banking system. This is under section 7 subsection A, that the Government of India has the power to give directions to RBI in matters of the public interest in consultation with the governor of RBI. So the government, the central government and the governor of RBI, if they together take decision that RBI needs to take certain steps in public interest, they can give these recommendations. They can advise the RBI. So it ensures that the central bank's actions align with the broader public and economic objectives. Now, this power was or has been till now used only once. The first and only reported use of this power was in October 2018. I will write it here. October 2018, addressing the issues such as liquidity for NBFCs and lending to the SMEs. If it is not visible to you, I will write it here. The Under section 7A, the power was used by the government of India to give directions to RBI only once in October 2018, addressing the issues such as the liquidity of NBFCs to the SMEs, the small and medium enterprises. So this power has been used only once. All right. This information is also important. A question can be asked. When was the section 7A used? Clear? Correct answer is option D. Next, which act brought the cooperative banks under the regulatory purview of the RBI and when did it take effect? Okay, I have already answered this question when we were discussing about the amendments that were made. So, which act or which step brought the cooperative banks under RBI's regulation? Option A, Banking Regulation Amendment Act 2020, effective from 26 June 2020. Option B, Multi-State Cooperative Societies Act 2002, effective from 2002. The Banking Regulation Act 1949, effective from 1st March 1966. And option D, Banking Laws Applicable to the Cooperative Societies Act 1965, effective from 1965. I hope you'll easily answer this question. The cooperative banks were brought under the purview of RBI with the Banking Laws Application to the Cooperative Societies Act 1965. Also, it added the 56th section, section 56 to the Banking Regulation Act. So, under section 56, the cooperative societies were included or RBI was given the regulatory purview through the Banking Laws Application to Cooperative Societies Act 1965. Alright, clear? So we'll remember this act from which the cooperative societies were brought under RBI's purview, regulatory purview, as well as we will remember the section, section 56 to the Banking Regulation Act. So it did not make an amendment to the RBI Act but to the banking regulation. A new law was created. Next question. Which regulatory body governs the dealings of banks and securities like shares and debentures in India? So we have various apex institutions like we have SEBI, Exim Bank, IRDAI, NABARD, the PFRDA. Here they are asking which regulatory body is going to govern the dealings of banks and securities like shares and debentures. Very simple question. Whether it is RBI, Ministry of Corporate Affairs, SEBI or IRDA, the Insurance Regulatory and Development Authority. Very basic question. Why I have included this here? Because all the questions will not be of the same high difficulty level. You will also find some easy questions, some scoring questions. So the securities like shares and debentures are governed by the SEBI, right? SEBI. So the regulation is enforced under the Securities Contract Regulation Act 1956. Remember this. Why I have provided this extra information in the explanation with all of the questions so that you can keep in mind these things also. You are going to find all of these questions in the PDF format along with the video in the description box after the marathon session has completed for today. Also, you'll find this in the Telegram channel, the link to which will be provided in the description box also. Alright, so make sure that you download this PDF and you revise all of the topics, all of the explanation that I am giving here along with the questions. So, the regulation of SEBI for the dealings of banks and securities like shares and debentures. This is enforced under the Securities Contract Regulation Act of 1956 along with the SEBI Act 1992. So SEBI's guidelines ensure that the banks they comply with the necessary regulations, maintain the integrity and transparency of the financial markets. So these two acts govern the securities, the bank's dealings with shares and debentures in India. the Securities Contract Regulation Act of 1956 and the SEBI Act of 1992. So the correct answer is option C, SEBI. Next question. What is the primary reason for the requirement of a license from the Reserve Bank of India under Section 22 of the Banking Regulation Act 1949 for commencing on carrying out? Okay, all of the information I have given here in the question itself. This question is telling us that there is a requirement of license from RBI under which section? Under Section 22 of which Act? Banking Regulation Act of 1949. For what? For commencing or carrying on the banking business. So when this act came into force or when this section was there, the banking entities that were existing before that also had to apply for the license. The new entities, when they're starting with or they're commencing the banking business, they had to apply for the license. But the older entities also had to apply for the license. Right? So why was this change made? Option A says to ensure banks comply with the tax regulations. Option B to allow only established and sound banks to operate. Option C to facilitate easier formation of new banking companies. Or option D to provide banks with the ability to issue checks and drafts. Try to answer this question. I want to see all of you answering this question. Which of the following options is correct? A, B, C or D? All right. So a very basic, a very simple question. The Section 22 requires licensing. Why? To allow only established and sound banks to operate. Right? So this provision intended to prevent the indiscriminate formation of banking companies, to maintain the stability and reliability of the banking sector. The RBI has the discretion to grant or refuse the license, which is based on relevant material and considerations. So under Section 22 of the Banking Regulation Act, licensing is required. All right. So when this came into force in 1949, the banking companies which were in existence, they were also required to apply for the license, that too within 6 months from the commencement of the act, right? And they were only permitted to continue business unless and until their applications were rejected by the Reserve Bank. If their applications are rejected, then they had to stop their business. Okay? RBI had the discretion to refuse or grant license when such decisions are taken. Now, this act also states that before RBI grants license to the banking entities, to the companies, they are required to be satisfied by an inspection of the books of the company, or that the company is in a position to pay its present or the future depositors all their claims, that the companies are not being conducted in a manner that is detrimental to the interest of the present or the future depositors, right? They should not be prejudiced, or the company, they are working in the public interest, they have adequate capital structure and earning prospects for the future. So after seeing all of these things, then only RBI was to grant the license to the banking companies. All right. Which of the following statements are true about the licensing policy for the universal banks in India? Now this first is a multiple statement type question, a multiple selection question. You are given four statements. Out of these, some are correct, some are wrong. You are being asked which of the following are correct or true for the licensing policy for the universal banks. These type of questions are being asked. If you have seen the questions, if you have attempted for the previous papers, so multiple selection type questions are in majority in the paper. So you need to know how you're going to approach this. Keep your mind very calm. Try to read the statements very carefully, thoroughly. Then only select the correct answer. The first statement says RBI issued guidelines for licensing new banks on February 22, 2013. The guidelines for on-tap licensing of the universal banks in the private sector was published on 1st August 2016. The Narasimham Committee recommended the need for a continuous authorization policy. The draft guidelines for on-tap licensing of the universal banks were released on 5th May. Take 10 to 15 seconds, read the statements very carefully, then give me the correct answer. Universal banks are those banks that provide various services, banking services under one roof. Yes, which of the following statements are correct? The correct answer is option A, that is 1, 2, and 3 only. 1, 2, and 3 only. 1 and 2 are true because RBI issued the guidelines for the licensing of new banks on February 22, 2013, and the guidelines for on-tap licensing were published on August 1, 2016. So these two dates and years you need to remember. What happened in 2013? Guidelines for licensing of new banks. In 2016, guidelines for on-tap licensing of universal banks. Statement 3 is correct because yes, Narsimham committee gave this recommendation that authorization for, on a continuous basis is required. However, the statement 4 is incorrect because it was these guidelines were not released in 2013 but in 2016. All right. So the correct answer is 1, 2, and 3. Now these type of questions are going to confuse you. They are going to bring your confidence down in the examination. But what we need to remember is there is no negative marking. You have already seen this information here if you're watching the video. But in case any question comes where you do not see, you do not recall studying that topic, still mark the answer. All right. So the correct answer is 1, 2, and 3. How we are going to use the elimination method here? Two statements are very different. Either option 2 will be correct or option 4 will be correct. Because here 2016 year is given for the release of the guidelines and here the year is given as 2013. Both the statements cannot be correct, be together correct, right? So we can remove these two options, option C and option D, which says 2 and 4 together. And we are left with a 50-50 chance of 1, 2, and 3 and 1, 3, and 4. Here we can make a calculated guess. Alright? So this happens when you keep your mind calm and you can make elimination. You can take the help of calculated guesses and you have used these strategies previously. So it is very important for you to practice MCQs, practice mock tests on a continuous basis in these last 7 days. Then only you will be able to quickly recall how we can use the elimination method. All right. Okay, moving on. Which of the following statements are true regarding the Section 23 of the Banking Regulation Act of 1949? So Section 23, again a question related to section. I know these questions you'll be finding it very difficult, but we have kept in mind the difficulty level of the previous exam as well as the previous papers of this 2024 session. Watch the exam analysis. The papers are very difficult. The questions that are being asked are very difficult. So you need to solve these difficult questions. Alright, so which of the following are true according to section 23? A banking company needs prior permission from RBI to open a new place of business in India. A banking company can change its place within the same city without Reserve Bank permission. Temporary places for business for special events can be opened without prior RBI permission up to 1 month. The Reserve Bank can revoke any permission granted under this section if the conditions are not met. So whether 1, 2 and 4 are correct, 1, 3 and 4, 2 and 3 or all of the following statements are correct regarding the section 23 of the Banking Regulation Act 1949. Which of the following statements are correct? Try to answer this question. So this is for getting the approval for opening the places of business. So there are options where the banks, they do not need prior permission of RBI, or there are situations where they are going to need permission from RBI. So according to the section 23, the correct statements are 1, 3 and 4 only. 1, 3 and 4 only. 1 is correct because the banking company does require prior permission from RBI to open a new place of business in India. 3 is true because temporary places of business for events can be opened without prior permission but up to 1 month. 4 is also true because the RBI can revoke any permission. But statement 2 is false because any change of location even within the same city does require the prior permission from Reserve Bank, right? So no banking company shall open a new place of business or they can change their business within the same city without the permission of RBI. So permission of RBI is important. Also, they cannot open a new place of business outside India or within the same city or the existing place in that country or area, right? RBI must be satisfied before granting any permission. The RBI, they can either impose or reference to a particular case, they can reject the approval. If at any time the banks have failed to comply with the conditions, the RBI can also revoke the permission that is given by them. Okay, so the correct answer is 1, 3 and 4. I hope you will remember this now. Next question. According to section 11, subsection 3 of the Banking Regulation Act 1949, what is the minimum paid up capital and reserves required for a banking company with places of business in more than one state if any place of business is situated in Bombay or Calcutta? Alright, so if a bank is opening up a business in any place in Bombay or Calcutta, and this they are doing in more than one state, then what is the required capital? What is the paid up capital and reserves required? Under section 11 subsection 3. Option A says 5 lakhs rupees, option B says 1 lakh, option C says 10 lakhs, or option D 25,000 rupees. This section, you'll remember, section 11 subsection 3 of the Banking Regulation Act 1949. So here the correct answer is option C, that is 10 lakhs rupees. So wherever a banking company with places of business in more than one state, where any such place is Mumbai or Calcutta, they're required to have a minimum paid up capital of 10 lakhs rupees. So that the banks that are operating in the major metropolitan areas, they maintain sufficient financial stability and capital adequacy. Alright. So the correct answer is option C, 10 lakhs rupees. 10 lakhs is the paid up capital for banking company that are going to open a new place of business. Next, under section 12 subsection 2 of the Banking Regulation Act, what is the maximum percentage of total voting rights a shareholder can exercise in a banking company? Again, related to the section 12 subsection 2 of the Banking Regulation Act, a shareholder, they have certain rights that they can exercise in the banking company. So what is the maximum percentage of the total voting rights? Whether it is 5%, 10%, 26% or 50%, the maximum percentage. So there is no specified ceiling on a person's holding of shares, right, in a banking company under the Banking Regulation Act. However, there is section 12 that puts certain restrictions on the voting rights. Shareholding, holding of rights is without any specified ceiling, but voting rights does have its own restrictions. So according to this section 12 subsection 2, no person holding shares in the banking shall respect in any shares they can exercise rights on the poll in excess of 10%. So the ceiling is fixed at 10%. The RBI may increase the ceiling to 26% in a phased manner if it deems necessary. This is to prevent any single shareholder from gaining disproportionate control over the banking company. So the maximum total voting rights of a shareholder can be 10%. This is under section 12 subsection 2 of the Banking Regulation Act. All right, which can be increased to 26%. This also you will remember, this also you will keep in mind. Next question. Which of the following statements are true regarding the formation of the subsidiaries by banking companies under section 19 of the Banking Regulation Act of 1949? So section 19 of the Banking Regulation Act talks about the formation of subsidiaries. So which of the following statements are correct according to this section? Subsidiaries can undertake any business permissible for the banking companies under section 6 subsection 1 clauses A to O. Subsidiaries can carry on the business of banking exclusively outside India with prior RBI permission. Statement 3 says subsidiaries can undertake any other business with prior approval of the central government as permitted by the RBI. And fourth statement says shareholding in any company by a banking company cannot exceed 30% of the paid up share capital of that company. Very lengthy options, very lengthy statements are given. But again, seeing the difficulty level, the questions that are being asked by the institution, you need to solve these questions. You need to have a grasp of the sections and the various provisions under these sections. So which of the following are correct? 1 and 3, 2 and 4, 1, 2 and 3, or 1, 2, 3 and 4? Regarding the formation of subsidiaries by the banking companies. The correct answer here is all of the following statements are correct. 1, 2, 3 and 4. Subsidiaries are permissible for specific purposes under section 6 subsection 1, and they can undertake businesses with prior approval from RBI, and there is a ceiling on the shareholding as well. Alright, so the correct answer is option D, 1, 2, 3 and 4. All of the following statements, all of the given statements are correct. Then, according to section 10A of the Banking Regulation Act, what percentage of directors in a banking company must have special knowledge or practical experience in the specified fields? So now we have moved on to section 10A. Right, section 10A. This is regarding the board of directors. So there are certain qualifications that are mentioned in section 10A of the Banking Regulation Act. The options are 25%, 51%, 75%, or 100% of the members of the directors in the banking company. So the correct answer here is option B, that is more than 51%. They should have special knowledge in fields such as accountancy, agriculture, banking, economics, finance, law, and small scale industry, among others, so that they have the necessary expertise to effectively manage and oversee the banking company's operations. So the correct answer is 51%. At least 51% they have special knowledge in these. Further, at least two of the directors should have special knowledge or practical experience in the agriculture and rural economy or cooperation or small scale industry. Right? 51% should have expertise in knowledge, and two of the directors should have special knowledge or practical experience in agriculture or rural area related activities. The correct answer is option B, 51%. Again, we will remember the section and the particular thing that is asked here. Okay. Next, Which of the following qualifications is required for a whole-time chairman or a managing director of a banking company under Section 10B of the Banking Regulation Act of 1949? So, Section 10A talks about the percentage of directors. Section 10B, subsection 4, talks about the qualification of the chairman or the managing director. Clear? We have covered this topic as well. Which section talks about the qualifications of a whole-time chairman or a managing director of a banking company? The correct answer is option the section 10B subsection 4. But this question here is particularly asking about what is the qualification. Option A, special knowledge and practical experience of financial, economic or business administration. B, being a partner in a firm carrying on trade, business or industry. C, holding a substantial interest in another company or firm. D, engaging in any other business or vocation. Try to answer this question. Yes, the correct answer here regarding the qualifications is option A that we already discussed, special knowledge. Every whole-time chairman or managing director must have specialized knowledge and practical experience of working in a banking company, a state bank of India or any subsidiary bank, financial, economic or business administration. All right? If you have a substantial interest in another company or you are engaged in another business or vacation or you are carrying on a trade, business or industry, then you are disqualified from holding the position of a full-time chairman or managing director of a bank. So the B, C and D options that are given here are related to the disqualifications. Only option A talks about the qualifications that are required. Next question. Which of the following principles are included in the OECD Principles of Corporate Governance 2004? So, corporate governance under the Organization for Economic Cooperation and Development. I hope you know the full form of OECD. So, it has defined the purpose of corporate governance. Also, it has stated certain principles. So, which of the following are correct? Promoting transparent and efficient markets consistent with the rule of law, protecting and facilitating the exercise of shareholders' rights, recognizing the rights of stakeholders and encouraging cooperation between corporations and stakeholders. And statement 4, ensuring that only majority shareholders obtain an effective redress for violation of their rights. Okay, use the elimination method and answer the question. One of the following statement is very much a negative one that cannot be correct. So although looking at the question at first might seem that it is very difficult, it is complicated, but it is quite easy if you can pinpoint, if you can point out the incorrect statement. So the correct answer is 1, 2 and 3 only. Why would it ensure that only majority shareholders they obtain an effective redress? When we see such a question, we get a little confused, a little nervous. We read the first three statements or the first two statements and then we go, oh, this is a very difficult one. I should skip it. I should not waste my time on this. But it is very important that you read all the four statements, all the given statements very carefully because many a times you will be provided with a particular statement that is going to be incorrect. You can simply eliminate it and you can mark the correct answer. Other statements are very much positive: efficient markets, facilitating shareholders' rights, recognizing the rights of stakeholders, right? OECD maintains equitable treatment of the shareholders, not only of the majority but the minority, the foreign shareholders, so that they have opportunity to obtain an effective redress for the violation of their rights. All right. So the OECD principles: disclosure and transparency, the responsibility of the board, the equitable treatment of the shareholders, ownership functions, corporate governance, all of these things are covered under this. Next, under Section 35A of the Banking Regulation Act 1949, which directions can the RBI issue to regulate the acceptance of deposits? So, under Section 35A, this section talks about the directions that the RBI can give to the banks regarding the regulation of acceptance of deposit. Which of the following are correct? A says interest rates on retail deposits only. B says conditions for moratorium on the acceptance of deposits. C says minimum and maximum period for which deposits can be accepted. Or option D, all of the above. Yes. So under section 35A of the Act, RBI can issue regulation of acceptance of deposits for all of the above. So the RBI is authorized to issue directions as it deems fit in the public interest, the banking policy interest, or the depositor interest regarding the moratorium, minimum and maximum period, interest rates, so that they can ensure stability and soundness of the banking system. All right. This was again a basic question. We already know that RBI can issue directions in all of these areas. Next, which of the following statements are true regarding the provisions for nomination in respect of articles kept in safe custody and safe deposit lockers as per the Banking Regulation Act? So, all the questions that we have been discussing, we have almost completed this session of 1 hour. We have seen so many questions. I hope you are understanding the difficulty level. I'm not trying to scare you, I'm not trying to make you nervous, but these type of questions are being asked. So you need to gear up. If you are giving your 70%, you need to put in the remaining 30% more. Then only you will be able to score the qualifying marks in the BRBL paper, because the difficulty level is quite high in this session. In all the other papers, even in today's examination, you would have seen how the difficulty level has increased. How the lengthy multiple selection type questions are being asked. So you need to solve these types of questions. So no need to be nervous. We are practicing these questions. We are going to discuss more than 50 questions, and you'll be able to easily solve them by the end of this session. All right. So now answer this one. Which of the following statements are true regarding the provisions for nomination in respect of articles kept in safe custody and safe deposit lockers? A person can nominate one individual to receive the contents of the locker in the case of their death. The nomination must be in the prescribed manner, and upon return of articles or removal of locker contents, the bank receives a valid discharge. For joint locker hirers with a survivorship clause, the bank must give access to the locker to the survivor and nominee after verifying the death certificate. The bank should deny access to the nominee until ownership of the locker contents is legally proven. Take 15 seconds and read the statements very carefully. Which of the following statements are correct? Which of the following statements are correct? All right, so the correct answer to this question is 1, 2, and 3 only. Why did I tell you to read the statement very carefully? Because the fourth statement says the banks should deny access to the nominee. the nomination regarding the safe custody, safe deposit lockers, the main principle that guidelines this activity is that no inconvenience should be given or faced by the nominees. So, a person can nominate an individual to receive the contents. It should be in the prescribed manner. Once the articles are returned, the bank should get a valid discharge. They must allow access to the locker after verifying the death certificate. However, they do not require a legal proof of the ownership of the locker contents. Alright, so the fourth statement is incorrect because it is going to cause inconvenience, and the banks are required to avoid any inconvenience. They should provide the most ease to the depositors, right? So the bank must verify the death certificate and the identity of the nominee, but legal verification or legal ownership of the locker contents is not required. Okay, so the correct answer is 1, 2, and 3. Next, which of the following statements are true regarding the regulation of interest rates under the Banking Regulation Act 1949? Regarding the regulation of interest rates, the RBI is authorized to regulate the interest rates for loans and advances as well as the deposits under Section 21 and Section 35A. The RBI's directions on interest rates should not discriminate against any class of depositors or loanees or banks. The interest rates on the deposits were regulated by RBI since 1949. And statement 4, the liberalization of the interest rates regime allows the banks to decide their interest rates independently. So which of the following are true regarding the regulation of interest rates as done under the Banking Regulation Act? Whether 1 and 3, 1, 2 and 3, 1 and 4 or 1, 2 and 4. Which of the following are correct? Okay, so the correct statements out of these four given here are 1, 2 and 4. That is option D. Interest rates were not regulated by RBI since 1949. The interest rates on deposits were not regulated until 1964. So this regulation started from 1964. And then liberalization of the interest rate regime now allows the banks, they can set their own rates. The RBI has mentioned the minimum and the maximum limits. Between this limit, the banks can set their own interest rates. Okay, so we will remember from here the section 21 and section 35A, under which RBI is authorized to regulate the interest rates for the loans and advances. Then they should not discriminate against any class of depositors, and liberalization has been created. Alright, so the correct answer is 1, 2 and 4. Which of the following statements are true regarding the marginal cost of funds based lending rate MCLR that is implemented by RBI? Which of the following statements are correct regarding it? The MCLR was implemented on 1st April 2016. It is determined by the current cost of funds including the repo rate. Banks cannot grant any loan below the MCLR except in certain cases permitted by RBI. The fixed rate loans of tenor above 3 years are priced with reference to the MCLR. So the marginal cost of funds based lending rate. According to that, which of the following statements are correct? So yes, it was implemented on 1st April 2016. Statement 1 is correct. The bank cannot grant any loan below that rate except certain cases that are permitted. This is also correct. It is determined by the current cost of funds. In the base rate, average cost of funds was used, but in the MCLR, the current cost of fund is used. So the correct answer is 1, 2 and 3 only. rate loans of tenor are priced with reference to MCLR is incorrect. They are exempted from the MCLR system. The fixed rate loans of tenor above 3 years are exempted. They are exempted. So a risk-based determination of the lending rates for the borrowers can be done using the MCLR. So MCLR is going to comprise of the marginal cost of funds, any negative carry on account of the CRR, then all the operating costs that are associated with providing the loan product or raising funds will be included, and the tenor premium as well, right? The cost arise from the loan commitments, and this tenor premium will be uniform from all of the for all of the users, for all of the type of loans. All right, then there are different types of internal benchmarks that are set, like overnight MCLR, one night, 3 month, 1 year MCLR. So these are the various things. Next, which of the following statements are true regarding the section 21A of the Banking Regulation Act? Now, what does the section 21A of the Banking Regulation Act talk about? It prohibits the courts from reopening the transactions between a banking company and its debtor on the ground that the interest rate is excessive. The section overrides the provisions of the Usurious Loans Act 1918 or any other law relating to the indebtedness in force in any state. The Supreme Court held that banks could compound interest on the annual rates and not half-yearly rates. It allows the courts to intervene if the interest rate is higher than the minimum that is set by RBI. Is the court allowed, after RBI takes a decision, after RBI sets a minimum rate, if the banks are charging a higher interest rate, can the courts, the Supreme Court, intervene in the particular matter? So the correct answer here is option C, that is 1, 2 and 3. The courts are prohibited. The courts are not allowed to intervene if the interest rate is higher than the minimum set by RBI. It prohibits the courts from reopening the transaction between a banking company and its debtor on account that the interest rate charged is excessive. Any law related to the indebtedness in the force in the state, it is overridden by the section 21A. Supreme Court upheld the provision's validity, and the banks, they cannot compound interest rate on annual rates, not half yearly rates. That is, they can only use the annual rates and not the half yearly rates. However, the court did not express any opinion on whether Section 21A would debar the courts from interfering if the circulars or directives of the RBI do not fix the maximum rate. If RBI has fixed the maximum rate, right, then the courts cannot intervene. They cannot reopen. But if they have not fixed the maximum rate, then whether they can intervene or not, it has not been set by RBI. So not the minimum set, but the maximum. So statement 4 is incorrect. The rest 1, 2 and 3 are correct. Next, which of the following is a requirement for the cooperative banks before offering the internet banking with transactional facility to their customers? So if a cooperative bank wants to offer internet banking to their customers, what is the eligibility? The CRAR of not less than 5%, gross NPAs less than 10% and net NPAs not more than 5%. The bank should have made a net profit in at least 2 out of the preceding 4 financial years. And option D, net worth of rupees 50 crore or more as of March 31 of the immediate preceding financial year. So what is the requirement for a cooperative bank before they offer the internet banking with transaction facility to their customers? The correct answer is option D. They should have a net worth of 50 crore in the immediate preceding financial year. Right? Other criteria, the CRAR should not be less than 10%. Gross NPAs should be 7%. That is, they should be less than 7%. And the net NPAs should not be more than 3%. and they should make a net profit in the immediate preceding financial year and at least 3 out of the 4 financial years. At least 3. Okay, so these statements are incorrect and option D is correct. I've also provided the explanation of why the other 3 statements are incorrect. So you will know the correct answer. Alright? Understood? Okay. Moving on. Which of the following is one of the salient features of the Integrated Ombudsman Scheme 2021 that is introduced by RBI? So RBI introduced the Integrated Ombudsman Scheme 2021. Right? What is the salient feature? The scheme integrates the existing 3 ombudsman scheme of RBI. Each ombudsman office retains its jurisdiction. Complainants must identify under which scheme to file their complaint. The scheme excludes non-scheduled primary cooperative banks. Which option is correct? Regarding the Integrated Ombudsman Scheme 2021 introduced by RBI. So, ombudsman, we already know it is the authority to receive and investigate on the public grievances against any government authority. If we are talking about the banking ombudsman scheme, which was originally under the 1995 by RBI, Section 35A of the Banking Regulation Act. Later on, it was modified by the banking ombudsman scheme of 2002, then 2006, right? So here we are being asked the salient feature of the 2021 scheme, and the correct answer is option A. It integrates the 3 schemes. The 3 schemes of namely the Banking Ombudsman Scheme of 2006, the Ombudsman Scheme for NBFC 2018, and the Ombudsman Scheme from Digital Transactions 2019. You have already studied about the Ombudsman banking ombudsman in the JAIIB preparation. So it subsumes all the 3 earlier schemes. Basically, to provide a unified and cost-free redress mechanism for the customer complaints involving deficiencies. It also includes the non-scheduled primary cooperative banks that have a deposit size of 50 crore and above. It adopts a one nation, one ombudsman approach by making the RBI ombudsman mechanism jurisdiction neutral. So you need not identify the area of your grievance or the state or the jurisdiction. There is an integrated ombudsman scheme for the whole nation. All right. Yes, the correct answer is option A. Next, what is the cash reserve required to be maintained by the scheduled bank? Okay, a very basic question. What is the correct option regarding the cash reserve ratio that is to be maintained by the scheduled bank? A fixed percentage of the bank's total demand and time liabilities as determined by RBI, an average daily balance without any statutory ceiling or floor as notified by RBI, 3% of the bank's total demand and time liabilities as per the earlier statutory requirement, a maximum of 10% of the bank's total demand and time liabilities. Although a simple question, we already know what is the cash reserve ratio. It is the particular percentage of the total reserves that the banks have to maintain with RBI, with the central bank. But this question has been made a little complicated, a little tricky. So, which of the following statements are correct? The correct answer is option B. It is an average daily balance without any statutory ceiling or floor rate as notified by RBI. So the cash reserve required to be maintained by a scheduled bank under section 42 subsection 1, average daily balance of the demand and time liabilities. The amended statute allows RBI to determine the CRR for the scheduled banks without any statutory ceiling. So more flexibility is provided to secure the monetary stability in the country. Okay. So the transfer to the reserve fund that was created earlier. The paid up capital, reserves of the aggregate value, they have to maintain the CRR, the scheduled banks. The quantum is decided by RBI from time to time according to the monetary stability situation. Average daily balances, liability, however, does not include the paid up capital and the reserves or any credit balance in the profit and loss account. Okay, so the correct answer is option B, average daily balance without any statutory ceiling. Next, what is the minimum denomination for a commercial paper as per RBI's directions issued on 10th August 2017? So, commercial papers that are released, that can be issued. So, what are the minimum denomination? Whether it is rupees 1 lakh, 2 lakh, 5 lakhs, or 10 lakhs. Which of the following statements are, or which of the following option is correct? What is the minimum requirement, minimum denomination? The correct answer is rupees 5 lakhs. According to RBI's directions, the minimum denomination for a commercial paper is rupees 5 lakhs and then the multiples of 5 lakhs. So the commercial papers are standardized, they are accessible to be eligible while maintaining a substantial enough value for the effective use in the money market operations. Okay, so the minimum denomination should be rupees 5 lakhs of the commercial paper. This is as per the RBI directions issued when? On 10th of August 2017. Next question. Who is required to sign the balance sheet and the profit and loss account of the banking company incorporated in India if there are more than 3 directors? So if a banking company has more than 3 directors, then who is required to sign the balance sheet and the profit and loss account? So, yes, all the banks whose shares are listed with the stock exchanges, they have to publish their unaudited quarterly results as prescribed by SEBI, right? They have to prepare the balance sheet and the profit and loss account as given in section 29 of the act. Also, this act contains that if there are more than 3 directors, then the signing of the balance sheet and the profit and loss account should be made by the manager or principal officer and at least 3 directors. This ensures that the financial statements have been reviewed and approved by the key individuals in the company. In the case of foreign banks, the manager or the agent of the principal office can sign these documents. So, in the case that banking company has more than 3 directors, then they must get the balance sheet and the profit and loss account signed by the manager or the principal manager plus at least 3 directors. If there are more than 3 directors, then they have to get it signed by at least 3 directors. All right? Yes, so the correct answer is option C. Next, which of the following statements are true regarding the submission of returns by the banking companies under the Banking Regulation Act? So, when the banking companies are making the submission of returns, then which of the following will apply? The banking companies must submit a monthly return of assets and liabilities to the Reserve Bank under Section 27. The annual accounts and balance sheet must be submitted to the Reserve Bank within 3 months from the end of the period. The banking companies must submit a quarterly return of assets in India under Section 25, subsection 1. And the Reserve Bank may call for information regarding the investments every half year. So, regarding the returns that are to be filed, which of the following statements are correct? So, every banking company has to submit a return of its liquid assets under Section 43, subsection 3, Section 24, subsection 3 of the Banking Regulation Act, right? Regarding the return on liquid assets. Then, under Section 27, monthly returns are required. Various other sections like section 25 subsection 1, a quarterly return regarding in assets. So there are various provisions. The correct answer here regarding the true statements is all of the above: 1, 2, 3, and 4. So yes, monthly return must be submitted. Annual accounts must be submitted to RBI within 3 months from the end of the period. Quarterly return of the assets must be submitted. And the Reserve Bank, if they want, if they deem fit, they may call for information regarding investments every half year. Okay. Also, the non-scheduled banks also have to furnish a return to the RBI under section 18 subsection 1 of the Banking Regulation Act. I hope it is clear. Yes. Next question. Which of the following transactions must the banks and the financial institutions maintain proper records for as per the RBI Master Circular on the KYC or the AML standards? So, which of the following activities need to be recorded? Proper transactions must be kept recorded. Option A, all the cash transactions of more than rupees 10 lakh or its equivalent in the foreign currency. Series of cash transactions valued below rupees 10 lakh each but exceeding rupees 10 lakh in a month when aggregated. Option C, all transactions involving the receipts of non-profit organizations of value more than 10 lakh. Or option D, all of the above. Read this question carefully and then try to answer. Yes, the correct answer here is option D, that is all of the above. Right? So, all of the above. So that transparency can be ensured in the prevention of money laundering and financing of terrorism. So, the banks, they need to maintain proper records. So here what I need you to do is remember all of these statements that are given here. What is the limit for the cash transactions of more than 10 lakh? Then transactions valued below but aggregated, it makes above 10 lakh. And NGOs that are having transactions of more than 10 lakh. So that the banks can identify, the RBI can identify if there is a case of money laundering or a case of terrorism or any other issue. Okay. Which of the following statements are true regarding the Board for Financial Supervision as established under the Reserve Bank of India Regulations 1994? So under the Reserve Bank of India Board of Financial Supervision Regulations 1994, a Board for Financial Supervision has to be established. So which of the following statements are correct regarding this board? The governor of the RBI is the chairman of the BFS. The BFS includes 3 directors from the Central Board of RBI as members. The BFS has jurisdiction over the nationalized banks, including the State Bank of India. Read the statements and then try to answer the question. Whether 1 and 2, 2 and 3, 1 and 3, or 1, 2, and 3. Which of the following given statements are correct? Yes, so the correct answer here will be option C, that is 1 and 3 only. 1 and 3 only. Statement 3 is incorrect because the BFS has jurisdiction over the nationalized banks, including SBI, ensuring comprehensive supervision and oversight of these institutions. This is the correct statement. Then statement 1, that the BFS is chaired by the governor of RBI. However, the option second, it includes 4 directors, not 3 but 4 directors from the Central Board of Reserve Bank of India. This is why the statement 2 is incorrect, making option C correct. 1 and 3 only. So 4 directors should be from the Board of Reserve Bank. Next question. Which of the following statements are true regarding the amalgamation moratorium of the banking companies under the Banking Regulation Act and the Companies Act? So regarding the amalgamation under Banking Regulation Act and moratorium for the Companies Act, which of the following are correct? The central government can order the amalgamation of two banking companies only after consulting the Reserve Bank. The Reserve Bank can apply to the central government for a moratorium in respect of any banking company. The period of moratorium, however, cannot exceed 12 months. During the moratorium, the banking company cannot make any payments to the depositors unless directed by the central government. Regarding the amalgamation and moratorium period, which of the following statements are correct? So, a bank may be amalgamated with another banking company under Section 44A. Under Section 44A of the Banking Regulation Act. For this, a scheme has to be prepared containing the terms of the amalgamation, the reason, and then it shall be placed before the shareholders of the companies, of both the companies separately. It has to be approved by a resolution passed by the majority of the members. Notice has to be given to each and every shareholders in this behalf. Amalgamation by government order can also be made, but it will be only after consultation with the Reserve Bank. So the correct answer here is option C, that is 1, 2 and 4. The period of moratorium cannot exceed 12 months is incorrect. It cannot exceed 6 months. All right, it cannot exceed 6 months. So the central bank is empowered to order the amalgamation under Section 396 of the Companies Act, Section 237 of the Companies Act 2013, but only after consulting the Reserve Bank. The Reserve Bank is authorized under Section 45 to apply for a moratorium in respect of any banking company. This cannot exceed 6 months. Like I just said, this moratorium cannot exceed 6 months. During this period, the banking company cannot make any payments to the depositors or discharge any liabilities unless directed by the central government. Alright, clear why statement 3 is incorrect? Because the moratorium cannot exceed 6 months and here we are given 12 months. Rest all statements are correct regarding the moratorium and amalgamation of the banking companies. Alright, next. Which of the following statements are true regarding the appointment and duties of an official liquidator for the banking companies? So here we are talking about the winding up of the bank. If a banking company, they're not able to pay back to the depositors, so winding up is synonymous to liquidation, mainly the process of dissolution when it ceases to do the business as usual. Alright, so which of the following statements are correct? The central government appoints a court liquidator for conducting all the proceedings for the winding up. The Reserve Bank, State Bank or any other bank notified by the central government can be appointed as the official liquidator. The liquidator must make a preliminary report to the High Court within 6 months. The depositors need to make individual claims to receive their dues from a wound up banking company. So which of the following statements are correct? 1 and 2, 3 and 4, 1, 2 and 4 or option D, which is 1, 2, 3 and 4, that is all of the above. So which of the following statements are correct regarding the winding up? The correct answer here is option A, that is 1 and 2 only. 1 is correct, 2 is correct. However, the liquidator is required to make a preliminary report to the High Court within 2 months. Not 6 months, but 2 months. Also, the depositors do not need to make individual claims to receive their dues. because their claims are seen to be filed as shown in the books of the banking company. So they need not make individual claims. All right. So first and second statement is correct, making option A, 1 and 2 the correct option. 3 and 4 is incorrect. Within 2 months, the preliminary report has to be provided to the High Court, and individual claims need not be made by the individual depositors because the books of the banking company will already show their claims. Okay, so the correct answer is option A, that is 1 and 2. We have only a few questions more, so bear with me because these questions are very important. You need to put in your 100%, even more than that, if you want to qualify this examination. Okay, next question. Which of the following statements are true regarding the penalties under the RBI Act? So there are certain penalties under the RBI Act. Which of the following statements are correct? Making a false statement or omitting to make a material statement knowingly is punishable with imprisonment up to 3 years and a fine. Failure to produce required documents or information can result in a fine up to 1 lakh for each offence. For continuing offences, a fine of rupees 5,000 per day may be imposed. The court will take cognizance of the offences under the Act without the need for a complaint by an officer of the bank. So, regarding the penalties for offences under the RBI Act. So, Chapter 5 of the RBI Act, the Chapter 5 of this particular Act deals with the penalty for the violation of the Act. Right? If the banking companies, they are making applications and furnish returns, they need to make the statements regarding the regulations, orders, directions. If, however, making these any statement, they're omitting some information, or they're putting in information which is false, or they're willfully trying to remove any information from the material statement, then it is punishable for imprisonment. Right? And how much punishment or fine is imposed? The correct answer is option C, that is 1, 2 and 3. Fourth statement is incorrect because the court will not take cognizance of the offences under the Act without a complaint by the officer. So only if an officer of the bank makes a complaint, then the court will take cognizance. Otherwise, it will not. So the statement states there is no need for a complaint by the officer, but that is not true. Sorry. The officer from the bank needs to make a complaint, then only cognizance can be taken. All right. Also, there are certain penalties that are under the Banking Regulation Act, Section 46 as well. That is also there. Okay. Moving on. Who appoints the auditors for the state bank and what conditions must be met for their appointment? So, regarding the auditors for the state bank, the central government with prior approval of parliament, the reserve bank without requiring additional approvals, the state bank with previous approval of the reserve bank, the state bank without needing any external approvals. So regarding the state bank of India, for the accounts and auditing, what conditions should be met? The correct answer is option C, that auditors are appointed by the state bank but with the previous approval of RBI. The state bank appoints its auditors, but this requires the previous approval of the reserve bank so that they meet the necessary qualifications. There is regulatory oversight over the auditing process, along with the report of the central board must be presented to the parliament for review. This auditor's report must be provided for review. All right. So this audit may be conducted by any person who is duly qualified to be the auditors, right? However, no director, a member of the local board or the local committee or an officer of the state bank will be eligible. This is to manage or avoid any form of prejudice or partiality. The appointment should be done with previous approval of Reserve Bank. Alright, so the correct answer is option C. Next question. Which of the following statements are true regarding the RRBs as per the RRB Act 1976? The RRB 1976 Act states what about the regional rural banks? The central government establishes RRBs by notification in the official gazette. The sponsor bank holds 50% of the issued capital of the RRB. The management of an RRB vests in the board of directors. The chairman of the board is appointed by the central government. So the Regional Rural Bank under the RRB Act of 1976, the section 3 of the act authorizes that the central government can establish the RRBs by the official notification. So this is under section 3. Alright, the management vests with the board of directors. The sponsor bank can also be created, which is a regional rural banks. So the correct answer here is option A, that is 1 and 3. The sponsor bank holds 50% of the issued capital is incorrect. Why? Because it holds 35%. It holds 35% of the issued capital. The RRB is established by a sponsor bank, right? So the sponsor bank will hold what percentage of the issued capital? 35%. It is sponsored by the regional bank, all right? And the central government is going to hold the 50%. So 35 is to 50 is to 15. The sponsor bank, central government and the state government. 15% is held by the state government. Okay, the management vests in the board of directors. However, the chairman of the board is appointed by the sponsor bank and not the central government. So the correct answer is 1 and 3 only. 2 and 4 are incorrect. You will remember this holding of the shared capital of RRBs. Next, which of the following schemes were framed under Section 9 of the Banking Companies Act of 1970-1980? The banking company's acquisition and transfer of undertakings under Section 9, which of the following schemes were framed? The Nationalized Banks Management and Miscellaneous Provision Scheme 1969, the Nationalized Banks Management and Miscellaneous Provision Scheme of 1970, the Nationalized Banks Management and Miscellaneous Provision Scheme of 1980. Or option D, that says both B and C. Yes, which of the following options are correct? The correct answer is D, both B and C. The central government framed two schemes under the section 9 of this act, and these schemes, they contain the details of the various aspects of the management and operations of the nationalized banks, including the constitution of the board of directors, appointment of the key personnel, terms of office, other governance and operational matters. Okay, so both B and C, that is option D, is correct. Next, which of the following statements are true regarding the Banking Regulation Amendment Act of 2020? This also we have discussed earlier. In the first few questions, I told you what is the Banking Regulation Amendment Act of 2020, right? So the act was deemed to come into force on 26 June 2020 except for certain sections. The amendment allows RBI to initiate a scheme for the reconstruction or amalgamation of a bank. During a moratorium, a bank can still grant loans and make investments. And fourth statement says the amendment applies to urban cooperative banks and multi-state cooperative banks. So, the Banking Regulation Amendment Act of 2020, although it was enacted on 29th of 2020, but it came into force on 26th of June 2020. except certain sections, that is except section 4. So this statement is correct, right? What else? The primary cooperative banks, which is related to section 4, it came into existence later on. Then the state cooperative banks, the central cooperative banks, again they came into force by the notification of official gazette. It had certain salient features like RBI can initiate a scheme for the reconstruction. This is under section 45. Regarding the moratorium, it cannot grant any loans. This was amended under the section 45(3), that they cannot make any loans during the moratorium period. And apart from that, yes, the cooperative banks under the state cooperative or multi-state cooperative banks, they can function. So the correct answer is 1, 2 and 4 only. Option statement 3 is incorrect. So C is the correct answer. It deemed to have come into force on 26 June 2020 except for specific sections, that is section 4 related to the primary cooperative banks, state cooperative banks and the central cooperative banks. Then it allowed RBI to initiate a scheme for the reconstruction or amalgamation. During a moratorium, a bank cannot grant loans or make investments. And the amendments to the urban cooperative and multi-state cooperative banks were made, which brought them under the supervision of the RBI. All right. So 1, 2 and 4 are correct and statement 3 is incorrect. Next question. Which of the following statements are true regarding the differentiated banks? Now, we already know what are differentiated banks. We have studied this earlier as well for our JIB preparation also. Differentiated banks that perform a particular financial activity. They are very different from the universal banks, right? Because they function in a particular segment. Basically, they are offering only a limited range of services or products, right? So they're also different on account of the capital requirement, the scope of activities. Okay, so that is why they are called as differentiated banks. So which of the following are correct? The differentiated banks offer a limited range of services or the products. Okay, the concept was first discussed in 2007. Urban cooperative banks, the PACs, RRBs, LABs may be considered. The concept or name was defined in a paper by IBI in August 2015. So, which of the following are correct regarding the differentiated banks? The correct answer is option A, that is 1, 2 and 3. This officially, the concept was defined by RBI not in 2015 but in August 2013, right? They offer limited range of services, different regulatory dispensation, first used in 2007. These can be categorized as differentiated banks because of their localized operation. Okay, right? So diverse opportunities can be provided by the differentiated banks. They have huge potential and they can provide big ticket as well as the low ticket unsecured loans. Risk management systems core competency should be harnessed better. So a committee was set up that recommended the financial inclusion on how the differentiated banks can work. This committee was under the, or this committee was known as the Nachiket More Committee. The Nachiket More Committee that was set up in 2013 for the setting up of what? The payment banks. Okay, this is what we are going to remember here. Next, under which chapters of the Reserve Bank of India Act 1934 is the Department of Non-Banking Supervision responsible for regulating and supervising the NBFCs? So we know the DNBS is responsible for the regulating and supervising of NBFCs, but under which chapter? Option A, chapter 3 and 5, option B, chapters 1 and 2, option C, 4 and 5, and option D, that is 2 and 4. So which of the following option is correct? A, B, C or D? A, B, C or D? The correct answer is option A. Option A, that is chapters 3 and 5. Right? So here the focus is on depositor protection, consumer protection, and financial stability. RBI has also the authority to take punitive action, including the cancellation of the certificates of registration and filing criminal cases or winding up of petitions. All right. So section chapter 3 and 5 talks about the supervision and regulation of the NBFCs as done by the DNBS. Next question. Which of the following is a requirement for an NBFC infrastructure finance company registered with RBI? So there are different types of NBFCs that can be established. We have the NBFC factors, the NBFC microfinance institutions, the infrastructure debt fund, the infrastructure finance company. All right. So which of the following is the requirement for the infrastructure finance company? A minimum net owned funds of rupees 100 crore, minimum of 50% of its total assets deployed in the infrastructure loans, minimum credit rating of B issued by any of the SEBI registered credit rating agencies, or option D, CRAR of 15% with a minimum tier 1 capital of 10%. Regarding the NBFC IFC, which of the following is correct? The correct answer is D, that is they require a CRAR of 15% with a minimum tier 1 capital of 10%. Okay. The applicable NBFCs, the non-deposit taking NBFCs, that is NDSI, or the deposit taking financial company, that is NBFCD, they should have the asset size of rupees 5 crore, the NBFC factor. For the infrastructure debt fund, 300 crore net owned fund should be there. For the NBFC infrastructure finance company, the correct things that are mentioned here are they must have a capital to risk asset ratio of 15%, tier 1 capital of 10%. All right, tier 1 capital of 10%. Then 75% of its total assets should be deployed in the infrastructure loans. Not 50, but 75%. Net owned funds should be 300 crore, not 100 crore. And they should have a credit rating of A, issued by any of the SEBI registered credit rating agency, CRA. Next question. Which of the following statements are true regarding the classification of NBFCs under the revised regulatory framework? So there are four levels in which the NBFCs have been divided based on their size, activity, and the perceived riskiness. These levels are asked in the question. So the base layer includes the NBFC taking NBFCs, non-deposit taking NBFCs, that is NBFC ND, below the asset size of rupees 1000 crore. The middle layer consists of all the deposit taking NBFCs irrespective of the asset size. The upper layer includes the NBFCs specifically identified by RBI as warranting enhanced regulatory requirements. And the middle layer includes NBFCs not availing public funds and not having any customer interface. So yes, the base layer includes the non-deposit taking NBFCs below the asset size of 1000 crores. Okay, we have the peer lending platform, the account aggregator, the financial holding company under the base layer. Then the middle layer will consist of the all deposit taking NBFCs, irrespective of the asset size, right? Other than that, non-deposit taking NBFCs that are of the asset size of 1000 crore and above, then standalone primary dealers, infrastructure debt fund, upper layer only specially identified by RBI, This is also correct. And then the fourth statement, not availing public funds, is not correct because the fourth level that we need to talk about is the top layer. The top layer, which is ideally kept empty. It may be populated only if RBI is of the opinion that yes, there is substantial increase in the potential systematic risk. So they shall be moved from the top layer to the top layer from the upper layer. All right. The fourth statement is incorrect. Okay. So go through this explanation. Everything that I just discussed is given here. Next, what is one of the key regulatory changes under the scale-based regulations applicable to the NBFC upper layer? So there are certain scale-based regulations changes that are made in the upper layer of the NBFC. Which of the following is correct? The NBFC upper layer must contain a common equity tier 1 capital of at least 6% of the risk weighted assets. The NBFC upper layer will not be subjected to any leverage requirements. They shall maintain a common equity tier capital of at least 9%. Differential standard asset provisioning is not required for NBFC. So, if you see the statements, so option A and option C are completely opposite. Option A says that it requires 6% of the risk weighted asset and option C says 9%. So either A or either C will be correct. So the correct answer here is option C. As I read the question, I can simply eliminate the other options. This will be possible only if you are practicing many questions, only if you are practicing the maximum possible questions. So, to enhance the quality of regulatory capital, the revised scale-based regulations require to maintain a common equity tier 1 capital of at least 9%. They will also be subjected to leverage requirements, ensure their growth. Also, they should hold differential provisioning towards different classes of standard assets. Right? Leverage requirements or standard assets will not be removed. If they're removed, then the regulatory compliance will be reduced. So the correct answer is option C. Next, which type of company does not require registration with the RBI as an NBFC? So which of the following do not require registration? A. Stockbroking companies or merchant banking companies registered under Section 12 of the SEBI Act. The housing finance companies regulated by the National Housing Bank. Nidhi companies notified under the Section 620A of the Companies Act 1956. Option D, all of the above. So which of the following do not require registration? The correct answer is option D. Why? Because all of these are regulated by their own apex institutions. Right? They are notified in the section. They do not require registration with RBI. These are governed by their own regulatory frameworks and hence are exempt from RBI's registration. Stockbroking companies, merchant banking companies, they come under the SEBI regulations. Housing finance companies come under the NHB. Nidhi companies, Companies Act. Right? So they do not require separate registration with RBI as an NBFC. So the correct answer will be option D, that is all of the above. All of the above. All right. Next, which of the following statements are true regarding the master agreement between banks and NBFCs? So we have studied about the bank NBFC linkage, how banks through NBFCs provide loans. So which of the following statements are correct? The master agreement may require the banks to take their share of individual loans originated by NBFCs into their books. If the statement entails an irrevocable commitment, it must comply with the guidelines on managing risk and code of conduct. Banks must comply with the master directions KYC, and the banks are allowed to enter into a co-lending arrangement with the NBFCs belonging to the promoter group. So which of the following statements are correct? Whether 1 and 3, 2 and 4, 1, 2, and 3, or all of the above, that is 1, 2, 3, and 4. So, regarding the co-lending arrangement, the banks are not allowed. The banks are not allowed to enter into a co-lending arrangement with NBFCs that are belonging to the promoter group. Specifically belonging to the promoter group, the banks cannot they cannot sign a co-lending agreement. All right. Other than that, KYC directions have to be followed by, and then the agreement, prior irrevocable commitment is there, then they have to make arrangements that they are complying with the extant guidelines, right? Okay, so the correct answer is 1, 2, and 3 only. Next question: which of the following statements are true regarding the major recommendations on the Committee of Banking Reforms in India? So the Committee of Banking Reforms in India made certain recommendations. Which of the following are true? The recommendations included strengthening capital adequacy measures and introducing stringent asset quality norms. Did they introduce very strict measures, or they talked about flexibility? The concept of asset reconstruction companies was introduced to handle the non-performing assets. The reform suggested included adherence to the Basel II norms. Many recommendations have been implemented while some are still under consideration. So, just like I said, flexibility is what is that is being followed in today's times. The reforms are making the banking system more flexible. So, the correct answer is 1, 2, and 4 only. 1, 2, and 4 only. The major recommendations of the committee included strengthening the capital adequacy measures and not and introducing the stringent asset quality norms so that issues like NPA can be addressed, eliminating the interest subsidies for the priority sector. Then asset reconstruction companies were introduced to handle the NPA. The reforms suggested the committee have been implemented, they are still under consideration. However, the reforms suggested included adherence to the Basel 3 norms, not Basel 2. Basel 3. Basically, the Committee on Banking Reforms that we are talking about here is the Narasimham Committee. The Narasimham Committee, which were in two parts. The first Narasimham Committee was set up in 1991 that gave recommendations regarding the structure, organization, functions, and procedures of the financial system, which suggested high SLR, high CRR, interest subsidy. Then the second Narasimham Committee of 1998, the Committee on the Banking Sector Reforms, it made major recommendations regarding NPAs, asset reconstruction, because bad debts, non-performing assets were very high in the Indian financial system. So stringent methods, risk weights, higher risk weights were required. So the correct answer is 1, 2, and 4. Next, which of the following statements are true regarding the regulatory reforms in the Indian banking sector? So, under the Narasimham Committee, the reforms that were suggested, which of the following are correct? The SLR was reduced from 38.5% in 1991-92 to 18% in November 2022. The capital to risk weighted assets ratio for scheduled commercial banks stood at 14.2% as of March 2019. The introduction of the counter-cyclical capital buffer, leverage ratio, liquidity coverage ratio, and the net stable funding ratio were part of the reforms. The RBI prescribes interest rates on the fixed or time deposits paid by banks to their depositors. So, which of the following are correct regarding the reforms in the Indian banking sector? The correct answer is 1, 2, and 3 only. RBI no longer fixes the interest rates. We have discussed this earlier as well. RBI mainly gives guidelines that this should be the interest rate, but they are not fixed. It is given to the flexibility of banks that they can decide their own interest rates on the time deposits that are paid by the banks to their depositors. So only 1, 2 and 3 is correct and statement 4 is incorrect. Right? Next question. Which of the following statements are true regarding the recent developments and requirements in the Indian banking sector? Regarding the recent development. So the Infinet was set up as the communication backbone for the financial sector. The Payment and Settlement System Act was promulgated in 2015. The banks are required to have IT systems in place for the identification of the NPAs. Many banks have embraced the new age technologies like AI, machine learning, robotics, and digital banking since 2020. Regarding the new developments regarding the technology. So yes, Infinite has been set up as the communication backbone, introduction of the negotiated dealing system. Then the promulgation of Payment and Settlement System Act in 2007 has been done. Introduction of RTGS, NEFT, ECS, ATMs. All the scheduled and commercial banks have to put in place appropriate IT systems. Also, since 2020, new age technologies have been implemented, tie-ups by the fintech companies, use of blockchain technology, all of these are being done. So the correct answer is 1, 3 and 4. Why? Because the payment and settlement system 2007, not 2015. All right. So the correct answer is 1, 3 and 4. Next, which of the following statement is incorrect regarding the government securities market and capital market in India? So we need to select the incorrect statement, not the correct but incorrect. The Reserve Bank of India participates in the primary segment of the government security market. The government securities include the government G-Secs, SDLs, treasury bills, cash management bills. The primary market for the capital market shifted from the controller of capital issues to free pricing and book building. Options and futures were introduced in the secondary market for the capital markets. So, we are talking about the reforms in the financial markets. We have studied about the monetary market reform, the money market reforms, also the government securities market, the capital market. The correct answer here is option A. The Reserve Bank of India participates. Why will the Reserve Bank of India participate in the primary segment of the government security market? Where the Reserve Bank of India participate is the open market operation, which is a measure that is taken by the Reserve Bank of India to control the inflationary or deflationary situation in the economy. But it is not a direct participant. All right. It does not participate in the primary segment since April 2006. Next, which of the following statements is incorrect regarding the Financial Sector Development Council, the FSDC? Which of the following statement is incorrect? It was constituted in December 2010. Primary objective is to strengthen and institutionalize the mechanism for maintaining financial stability. It is a statutory body. The Finance Minister of India is the chairman of the FSDC. So the FSDC was, yes, constituted in 2010. Various segments, various regulators there are for the segments like RBI for commercial banks and NBFC, SEBI for capital market, IRDA for insurance, PIFRDA for pension funds, etc. Okay, and the according to the government of India set up FSDC with finance minister as the chairman, but it is not a statutory body. It is not a statutory body. Okay, right? So the finance minister does serve as the chairman. It is not a statutory body. Correct answer, or we can say the incorrect option, the incorrect statement about FSDC is that it is a statutory body. Other things regarding the FSDC, which of the following statements are true regarding the structure and functions about FSDC and its wings? The FSDC subcommittee is chaired by the governor of RBI and includes all the members as well as the additional members like the deputy governors and additional secretary. The Interregulatory Technical Group was set up in September 2012 for the coordination among financial sector regulators. The Technical Group on Financial Inclusion and Financial Literacy was set up in 2011, chaired by the DG of RBI in charge of the financial stability. The FSDC subcommittee meets less often than the full council. So regarding its subcommittee, the wings, we have the FSDC subcommittee, the Interregulatory Technical Group, the Technical Group on Financial Inclusion, Interregulatory Framework, Working Group on Resolution, Crisis Prevention Group, Early Warning Group, Macro Financial Monitoring Group. All of these are the subcommittees. But here the correct answer is option A, that is 1 and 3 only. 1 and 3 only. It is chaired by the governor. FSDC subcommittee includes all the members, so it makes statement 1 correct. The Interregulatory Technical Group was set up in September 2011 for the interregulatory coordination. Not in 2012, but in 2011. So statement 2 becomes incorrect. Right? Statement 3 is correct because yes, the technical group was set up in 2011, but the FSDC subcommittee meets more often than the full council. So the correct answer is 1 and 3 only. You also need to know the functions like the FSDC subcommittee for functional responsibility, then the interregulatory technical group, as the name suggests, for the technical responsibilities, right? Issues related to the financial stability and coordination. Then financial literacy and financial inclusion subcommittee, financial conglomerates. So this is how the subcommittees work. Then which of the following statements is incorrect regarding the roles and responsibilities within the Financial Sector Development Council? FSDC is a very important topic. So which of the following statement is incorrect? The Macro Financial Monitoring Group is chaired by the Chief Economic Advisor. The Early Warning Group was set up in June 2012 to coordinate the response of the Government of India and regulators during the crisis situation. The Interregulatory Technical Group is headed by the DG of RBI in charge of financial stability. The Technical Group on Financial Inclusion and Financial Literacy was set up to discuss issues related to the financial inclusion and literacy. Which of the following statement is incorrect? We have been asked the incorrect statement, and the incorrect statement is option C. Option C, because it is headed by the executive director, not the DG but the ED in charge of financial stability. And other statements are correct. Alright, I hope it is clear about the different subcommittees of the Financial Sector Development Council as set up by the government. And that is all. We have covered more than 50 questions, around 60 questions from module A from all the topics. FSDC was actually the last topic from the last unit of module A. So we have completed this first marathon of module A of the BRBL paper. Now what I need you to do is you need to download the PDF. Either you can download it from the description or you can download it from the Telegram channel. The link will be given. And then you need to revise all of these questions along with the explanations that are given, and you need to do it tomorrow in the morning. And then you will attend the second marathon in the evening, same time, 9 p.m. Alright, so this revision is as important as attending the session. If you are only attending the session and you're forgetting about the topics, it won't be useful. So you need to make the revision. You need to do the revision tomorrow. It will take only half an hour or 45 minutes to revise. Alright, so do it tomorrow. Now I will end the session. We have already done this session for more than 2 hours. I will meet you again tomorrow 9 p.m. on this channel with the module B, that is the second marathon. Now you take rest and revise tomorrow. Thank you for attending the session. Make sure to attend the other sessions as well. Good night.